The S&P 500 is like a big scoreboard that keeps track of how well 500 of the biggest companies in the U.S. are doing in the stock market. It's officially called the Standard & Poor's 500 Composite Stock Price Index, but everyone just calls it the S&P 500. If you want to know how U.S. stocks are doing overall, this is a handy tool to check. The companies in it have a whopping $7.1 trillion in assets. Crazy, right? The stock market has been going up lately after a bumpy ride in the past. Since late October, the S&P 500 went up by more than 12%, and it's up over 20% since the start of 2023. Some folks feel positive about this, thinking it's a good time to invest. But others worry because many stocks are pricier now than a few months ago. So, is it still a good idea to invest in the S&P 500? And should you wait, thinking prices might drop again? The answer might be surprising. I'm Will, and I teach people about investing, personal finance, and money. I've walked the path you seek, and today I have several businesses and investments that provide me income every single month, meaning I never have to work another day in my life. If you plan on becoming financially free, be sure to subscribe to the channel and hit the like button if you find this video valuable. Now, to figure out if investing your money into the S&P 500 is still a good move, let's check out its recent performance. So in 2023, the S&P 500 hit a milestone by closing above 4,700, a level not seen since January 2022. It's been a winner, boasting a 23% increase and maintaining an average annual return of over 10% since 2008. Over the past decade, the big shots in the tech world have pretty much owned the show. More than a quarter of the index is made up of the tech sector, and top dogs like Apple, Microsoft, and NVIDIA hold the fort. And here's an interesting fact. NVIDIA alone is almost as valuable as the entire real estate sector. Amazon takes bronze as the third largest company in the index, even though its shares took a hit in 2022 due to a sales slowdown. In 2023, the company's shares grew by a whopping 81%. Another big player, Tesla, part of the consumer discretionary sector, had a comeback too, securing its spot as the index's 10th biggest stock by weight. So things are looking interesting. In the financial realm, Berkshire Hathaway are the leaders with a hefty 1.7% weight, making it the key player in this sector. On the healthcare front, United Health Group claims the top spot with a 1.3% weight, towering over even the largest bank in the U.S., J.P. Morgan Chase. Speaking of sectors, information technology, healthcare, and financials are the big shots in the S&P 500, collectively making up over half of the entire index. They hold significant sway. Now, on the flip side of the S&P 500, the financial sector witnessed some dramatic setbacks. Signature Bank and Silicon Valley Financial Group took the biggest hit in the first quarter of 2023, experiencing near total collapse in just 30 days, losing almost all of their value. Zooming in on the first 3 months of the year, it's noteworthy that 7 of the 10 worst performers on the index were either banks or financial companies, signaling some turbulence in the financial sector. So, there were 2 major trends last year. First off, the colossal gains in the index were largely attributed to 7 tech giants: Apple, Microsoft, NVIDIA, Google, Tesla, Meta, and Amazon, all boasting double or even triple-digit returns. On the flip side, the energy and healthcare sectors are experiencing significant outflows, with $9 billion and $4 billion respectively making their exit. It's a dynamic landscape with some sectors thriving and others facing challenges in the current market climate. The longevity of the S&P 500 rally is currently under speculation as we step into the new year. Market observers and experts are weighing in on their predictions for where the S&P 500 and the broader markets might head. According to a recent CNBC Fed survey, a collective opinion from money managers, strategists, and economists anticipates a modest gain for the S&P 500 in 2024, with a projection of less than 2%, reaching about 4,696. Additionally, the consensus suggests that the S&P might breach the 5,000 mark for the first time, but not until 2025. On a personal note, I'm optimistic about the index hitting 5,000 in 2024, and there's even potential for it to go higher, contingent on the absence of a recession. Financial experts generally tout the idea that investing in an S&P 500 index fund is a solid strategy, although they also advise leaving room for diversification. If you're enjoying the video, please hit that like button. I'd really appreciate it. Thanks. Okay, so is the S&P 500 still worth your time, even in 2024? Well, to answer this, I want to highlight three things. Number one, impressive historical performance. Investing in the S&P 500 has been remarkably successful over the years. From 1980 to 2022, excluding dividends, the index boasted an average annual return of 10%. Since its inception in 1957, it has averaged about 10.7% annually. In the past decade, the S&P 500 performed even better, with an average annual return of approximately 14.7%. Many consider the S&P 500 the epitome of index investing, and its track record, particularly since the financial crisis, has been outstanding. A bootstrapping analysis from 2009 to 2018 revealed that the actual performance of the S&P 500 during that period was statistically impressive, with only 0.5% of simulated scenarios outperforming its risk-adjusted returns. However, it's crucial to remember that past performance doesn't guarantee future results, as evidenced by the challenging lost decade from 1999 to 2009. Number two, actively managed nature. Contrary to common belief, the S&P 500 is not a simple collection of the 500 largest U.S. stocks. It operates on a committee-based system where people, not algorithms, make decisions about which stocks are included. While there are specific criteria for selection, the human element in the committee introduces subjectivity. The committee's goal is to construct an index reflecting large-cap U.S. equity markets, but the involvement of humans adds complexity and reduces the predictability of replicating past exceptional results. Understanding the active management component is essential if you plan on relying on the S&P 500 for your investment strategy. Number three, diversification beyond the S&P 500. While the S&P 500 covers a substantial 80% of the U.S. stock market capitalization, it represents only a fraction of the full spectrum. With nearly 3,500 stocks in existence, relying solely on the 500 included in the S&P means missing out on the potential offered by the broader U.S. stock market. Moreover, there are thousands of excellent stocks globally that are not part of this index. Although a handful of stocks have historically driven significant wealth creation, the long-term outperformance of smaller stocks, including the approximately 3,000 not in the S&P 500, is a noteworthy trend. While the S&P 500 has showcased impressive recent performance, the probability of sustaining such results is low. Well-informed investors understand that discovering winning stocks is akin to finding a needle in a haystack, and forsaking diversification may come with a substantial cost. Setting aside historical performance, a commonly heard argument favoring S&P 500 investment is that roughly half of its constituents generate revenues from outside the U.S. While this international exposure can be advantageous, it's important to weigh this against the broader landscape of investment opportunities beyond the S&P 500 for a more comprehensive and diversified portfolio. Now, no conversation about investing in the S&P 500 or U.S. stocks is complete without addressing valuations. While market timing isn't an exact science, it's well established that current valuations often serve as a reliable indicator of future returns. In simple terms, when prices are high, future returns tend to be lower. As of July 31, 2023, the S&P 500 boasted a price-to-earnings ratio of 31.4. This figure stands at a substantial 55.7% above the modern-era market average of 20.2, positioning it 1.4 standard deviations above the norm. These metrics suggest that the market is currently overvalued. Investors, therefore, face the challenge of weighing the potential for future returns against the current high valuations. Understanding this aspect is crucial for making informed decisions and managing expectations in the dynamic landscape of the stock market. Overall, investing in the S&P 500 can be a good idea if you're seeking exposure to large-cap U.S. stocks, and especially if you are a long-term investor. However, it's crucial to be aware of current market conditions, potential overvaluation concerns, and the actively managed nature of the index. Diversification is key, and you need to carefully evaluate your own financial situation, risk tolerance, and investment goals before making any decisions. Consulting with a financial advisor can provide personalized guidance based on your specific circumstances. If you're interested in the best 5 dividend stocks for 2024, in my opinion, why not check out this video next?